What if the best investment you can make right now has nothing to do with the stock market? What if the highest returning asset you have access to, the one with the potential to generate returns that no index fund can reliably touch, is sitting inside you? Not a self help pitch, not a motivational poster, a specific, calculable financial argument for why, at certain income levels and career stages, investing in your own skills and earning capacity produces returns that dwarf what the market offers, and why most personal finance advice gets the sequencing completely wrong. Let me tell you about two friends. Same age, same starting income, same city, both 25, both earning $38,000 a year in entry level roles. Both have $200 a month they can direct somewhere intentional. Friend 1, call her Sade, puts her $200 into a broadly diversified index fund every month. She has watched enough finance videos to know this is the right move. She automates it. She leaves it alone. She feels responsible and ahead of her peers. Friend 2, call him Dev, spends his $200 differently. Year 1, an online data analytics course, $180 total, 12 weeks of evenings and weekends. 6 months after completing it, Dev uses the new skill set to negotiate a move to a data analyst role at his company. Salary increase, $11,000 a year. Year 2, a data visualization certification, $240, 8 weeks. Dev is now the person on his team who can tell the story in the numbers. He gets visibility, he gets a raise, another $6,000 a year added to his base. Year 3, a project management qualification, $380, 4 months part-time. Dev leads his first project. Another move, another $9,000 jump. 3 years in, Dev earns $64,000. Say earns $38,000. With modest raises for cost of living, her investment account has grown to approximately $8,100 at 8% average return. Dev has invested approximately $800 in courses over 3 years. The return on that $800, measured as the income increase it produced, is an additional $26,000 per year in salary. On an $800 investment, that is not a return percentage. That is a return that does not fit on a conventional return scale. And that additional $26,000, if Dev now directs even a portion of it into the same index fund Sade has been building, compounds on a base that Sade's $200 a month contributions cannot match for years. The skill investment did not replace the market investment. It dramatically accelerated what the market investment could eventually become. To understand why this works, and when it works, you need to understand the concept of human capital. Human capital is the economic term for the value of your skills, knowledge, experience, and earning capacity. It is an asset. Like a stock or a property, it has a current value and a potential future value. It can be invested in, it can appreciate, it can generate income. Unlike a stock or a property, it cannot be taken from you by a market crash. It moves with you across jobs, cities, and economies. And in the early stages of a career, it is almost certainly the largest and most valuable asset you own. Think of it this way. At 25, with $8,000 in an investment account, your financial capital is $8,000. But your human capital, the present value of your future earning potential over a 40-year career, is potentially worth hundreds of thousands to millions of dollars, depending on your field, your trajectory, and the skills you develop. The investment account is the small pond. Your earning capacity is the ocean. And in the early years of a career, investments that expand the ocean produce larger absolute returns than investments that add to the small pond. Here is the specific mathematical reason. The stock market, over long historical periods, has produced average annual returns in the range of 7 to 10% for diversified global portfolios. This is real and it compounds powerfully over time. But a skill investment that produces a salary increase produces what economists call a return on human capital. And at lower income levels, these returns can be dramatically higher. Dev spent $800 on courses. The resulting salary increases, $26,000 per year, represent a return on that $800 investment that, annualized and compared to the initial outlay, is effectively uncalculable in conventional percentage terms. Even if we compare it more conservatively, the $26,000 additional annual income earned over the next 30 years of his career represents over $780,000 in additional lifetime earnings from $800 in courses. No index fund delivers that on $800. Now, two important honesty points before we go further. First, not every skill investment produces a salary increase. The return depends on the relevance of the skill to marketable demand, the quality of the learning, and the ability to actually deploy the skill in a context that rewards it. Dev chose skills with clear market value in his industry. He did not take a random course hoping it would pay off. Second, this argument has a limit. As income grows and financial capital accumulates, the relative return advantage of skill investment decreases. A person earning $200,000 a year with $500,000 in investments gets different mathematical guidance than a person earning $38,000 with $8,000 in investments. The sequencing matters, and we will get to it. Let me extend Devin Sade's story across a longer timeline to show the full picture. Years 1 through 5. Dev directs $200 a month to skill investment, approximately $2,400 a year in courses, certifications, and professional development. His salary grows from $38,000 to $72,000 over 5 years through a combination of skill-driven promotions and strategic job moves. Sade directs $200 a month to index fund investing. Her salary grows modestly. Cost of living increases and one small promotion. She earns $46,000 by year 5. Sade's investment account at year 5, approximately $14,700 at 8% average return. Dev's investment account at year 5, 0. He has been investing in skills, not markets. Dev's income advantage over Sade by year 5, $26,000 per year. Year 5, the transition point. Dev now earns $72,000. His skill investment phase has produced its major returns. His human capital is substantially developed. He begins directing $800 a month to index fund investing, the amount his income advantage now makes available. Sade continues her $200 a month, 10 years from the start, year 10. Dev's investment account, 5 years of $800 monthly contributions at 8% average return, approximately $58,000. Sade's investment account, 10 years of $200 monthly contributions at 8% average return, approximately $36,700. Dev started investing 5 years later than Sade. He invested 4 times as much per month because his skill investments produced an income base that made it possible. He is ahead by $21,000 in investment value, despite starting half a decade later, 20 years from the start. Dev's account, 15 years of $800 monthly, plus the compounding of the previous 5 years at $800, approximately $278,000. Sade's account, 20 years of $200 monthly, approximately $118,000. Dev is ahead by $160,000 from a strategy that started by investing in skills rather than the market for the first 5 years. This is not an argument against index investing. It is an argument for getting the sequencing right. Here is how to think about and execute your own skill investment strategy, and how to know when to transition to market investing as the priority. Step 1. Identify your income bottleneck. The first question is not what skills should I learn? It is, what is limiting my income right now? Is it a specific qualification or certification that gates entry to higher paying roles? Is it a technical skill, data, coding, financial modeling, design, project management that your current role rewards but you have not formalized? Is it a communication or leadership skill that is limiting your visibility and promotion trajectory? Is it simply that you are in the wrong industry for your current skill set, and a lateral move into a higher paying sector requires a specific credential? The highest return skill investments target the specific bottleneck in your earning capacity, not the most interesting course available, the one that removes the specific constraint on your income. Step 2. Research the actual market return on target skills. Before investing in any course or certification, spend 30 minutes researching the salary differential for roles that require it versus roles that do not. Job boards in most countries show salary ranges by role. LinkedIn salary data, Glassdoor, PayScale, and regional equivalents give you real market data on what specific skills and qualifications command. If the skill you are considering produces a salary differential of $8,000 to $15,000 annually, and the course costs $400, the return calculation is straightforward and compelling. If the course is $8,000 and the likely salary differential is $3,000, the math is much less compelling. Research the return before you pay for the education. Step 3. Prioritize skills with compounding career value. Not all skills have equal career longevity. Some skills are immediately marketable but depreciate quickly. Others compound, each level of mastery making you more valuable and building on the previous layer. In the current 2026 economy, skills with strong compounding career value include data literacy and analysis, financial and business acumen, regardless of your role, effective communication and writing in an AI saturated information environment, project and stakeholder management, and technical skills in fields undergoing significant growth. Skills that are purely trend dependent, highly specific to platforms or tools that may not exist in 5 years, carry more depreciation risk. Aim for skills that compound with experience rather than skills that expire with a tool version. Step 4. Use free and low-cost resources before paid ones. The correlation between the cost of a course and the value of the skill it develops is weak. Google Career Certificates, Coursera, and EDX with financial aid options. YouTube tutorial series for technical skills. Free resources from professional associations. Library digital resources. Many public libraries now provide free access to platforms like LinkedIn Learning. Start with free. Validate your interest and aptitude. Invest in paid credentials once you have confirmed the direction and the market demand for what you are learning. Step 5. Know your transition point. This is the step most people miss. They either invest in skills forever without building financial capital, or they invest in markets from the beginning without building income capacity first. Here is a simple framework for the transition. Continue prioritizing skill investment while your income is growing at a rate faster than your investment account could grow through market returns alone. Begin shifting priority to market investment when your income growth has plateaued, when the marginal return on additional skill investment is less than the marginal benefit of increasing your investment contribution. For most people in early careers, this transition happens somewhere between year 3 and year 8, depending on the field and the pace of income growth. The transition is not all or nothing. It is a gradual shift in where each additional dollar goes, from skills toward markets, as the income capacity grows. Step 6. Once the transition begins, invest the income gains immediately. The most common failure mode for people who successfully grow their income through skill investment is allowing lifestyle inflation to absorb the gains before they reach an investment account. When the skill investment produces a salary increase, automate the difference into the investment account before the lifestyle expands to meet it. Dev's $200 a month to $800 a month transition only works if the $600 increase is automated into investing the same month the salary increases. If it disappears into lifestyle first, the skill investment produced income growth without producing wealth growth. Automate the gain immediately, every time. Here is the reframe I want you to carry out of this video. Most personal finance conversations treat investing as the first priority for any available dollar. And for people with substantial income and established careers, that is probably right. But for people in the early stages of building income, where the income itself is the limiting factor on how much can ever be invested, skill investment often produces higher returns on the marginal dollar than market investment, because the market compounds what you already have. Skill investment compounds what you will have, and what you will have across a 40-year career is determined more by income trajectory than by the return on any individual investment. This does not mean skip the index fund. It means understand which asset produces the highest return on the next dollar at your specific stage of the journey. Sometimes that is the index fund. Sometimes it is the $300 course that moves you into a role paying $15,000 more a year. The financially sophisticated answer is not always the one the finance videos tell you first. Dev and Sade both made smart decisions. Sade built the habit of market investing early and consistently. That habit will serve her for decades. Dev built income capacity first and deployed it into markets when the income could support meaningful contributions. That sequencing produced a larger financial outcome at the same point in time. Neither of them is wrong, but one of them understood something the other did not: that the highest returning investment at 25 on $200 a month is rarely the stock market. It is almost always yourself, your skills, your market value, your ability to command a higher income, which then funds the market investments, which then compound on a base that the $200 a month contributions could not reach for 20 years. Invest in the market, build the habit, automate the contribution, but do not let the market investment become an excuse to stop investing in the asset with the highest long-term return potential. You. What skill do you need to develop this year to be worth meaningfully more in 3 years? That question, answered honestly and acted on consistently, may produce the highest return of anything you invest in during the next decade. Drop a comment and tell me, what is the skill or qualification that you believe would produce the biggest income jump in your career right now? And what is stopping you from pursuing it? Tell me your field and your situation. I read every comment, and I will give you my honest view on whether the skill investment math works for your specific case. If you know someone who is putting every available dollar into the market while their income is stuck and their career is stagnant, share this video. The sequencing conversation might be the most valuable financial conversation they have this year. Subscribe to Nuella Invests. Every week, we cover the financial decisions that actually move the needle, not just the conventional ones. See you in the next one.